Be your own bank? Not quite. The insurance company is the bank. They set the rates, charge the interest, and can cancel your policy if the loan balance gets too high. That is the truth about infinite banking. Hi, I'm Phillip Smith, financial planner with Tidepool Wealth Strategies, helping people who are about to retire step into retirement with clarity, confidence, and tax-efficient income that's meant to last. Welcome to
the perfect retirement plan.
You may have heard the pitch in places like TikTok. Be your own bank. It sounds slick. Use a life insurance policy, borrow from yourself, skip the banks, and grow your money tax-free. But here's the problem. Even some of the loudest anti-debt voices on the airwaves, the kind who make a living telling you to cut up your credit cards, warn that this strategy is full of holes. And they're not alone. University research shows how high costs early on can eat away at cash value. Policy loans quietly chip away at your death benefit. And if the policy lapses, the IRS is going to show up at the party with a tax bill you never expected. On top of that, plenty of CPAs and CFPs will tell you the long-term returns rarely live up to the glossy sales illustrations, which can be manipulated. So today, here's where we're headed. First, what infinite banking really is in plain English. Then, why this idea is so popular. We'll walk through the big promises compared to reality, the serious tax traps that promoters gloss over, and the sustainability problems. We'll also talk about the illusion behind the word infinite, who this might actually work for, and why that's a very narrow slice of people. And finally, we'll talk about what works better for most people who are nearing retirement. Now first, what infinite banking really is. Let's start by stripping this down to the basics. Infinite banking, or be your own bank, is built around whole life insurance. The idea is you pay large premiums, build cash value in the policy, and then borrow against that cash value instead of going to a traditional bank. The sales pitch says you're in control, you never lose the growth, and you're not beholden to any big banks. Now, here's the really critical thing to understand. You're not borrowing from yourself. The insurance company gives you the loan against your policy. They set the loan interest rate. They charge you interest. And if your loan balance plus interest grows too large, they will force your policy to lapse, leaving you with a tax bomb and no life insurance coverage. And full transparency, just so you know where I stand, I am licensed to sell life insurance, and I've placed policies as recently as this year when it truly made sense for a client's circumstances. I believe life insurance can be a valuable tool of stewardship when used to protect your loved ones, but I will never recommend it as a be your own bank strategy. Used appropriately, life insurance is about care and responsibility, not gimmicks or shortcuts or tricks the wealthy don't want you to know about. Now, here's why this whole be your own bank, infinite banking thing is popular. The concept has exploded on social media because it taps into two powerful themes: financial control and distrust of banks. People love the idea of cutting out the middleman, sticking it to Wall Street, and taking charge of their own money. Add in the buzzwords tax-free growth, guaranteed access, financial freedom, and it sounds like the ultimate financial hack. The aggregate theme is empowerment, which is good, at least on the face. Promoters package it as the one strategy banks and the government don't want you to know about. They lean into the distrust of institutions, painting this as an insider secret. And the viral nature of short-form video makes it easy to oversimplify. A 30-second reel can promise financial freedom without ever mentioning the decades of funding requirements, the interest charges, the tax risks, or the financial institutions that create the life insurance policies. It seems kind of, misleading. Misleading is the right word. It's the only word I can think of off the top of my head, but it is just the right word. The hype is why the strategy has caught fire. Now let's talk about promises versus reality. The promise is appealing: tax-free growth, tax-free borrowing, financial independence. But the reality? Cash value takes years, sometimes, most of the time, decades to build meaningfully because upfront costs and commissions erode the cash value. There's just no cash value for the first few years typically. And during that time, your money could have been working harder in simpler accounts with lower costs and better liquidity. Here's a real-world example. One certified financial planner located in the Midwest compared a 45-year-old client's proposed policy to simply investing the same premium into a balanced portfolio. After 20 years, the portfolio is projected to have nearly double the liquid value compared to the policy's cash value. and the portfolio didn't require locking into an insurance contract. And the so-called tax-free borrowing, it's not magic either. It's just a loan. The insurance company controls the terms, not you. And if you don't repay, they'll reduce your death benefit or force a policy lapse. That's not control. It's a definitive example of dependency on the man. Not that I'm against the man. I just think people need to have some perspective. Let's talk about the biggest thing promoters gloss over. The biggest piece of this whole thing that gets swept under the rug is this. To make the quote unquote be your own bank story work, you need to keep feeding the policy with premiums for decades. When you have that loan, you either pay it back or eventually find yourself having to pay the interest at minimum to keep the policy from lapsing. Promoters show rosy illustrations but rarely explain how rigid and unforgiving the funding schedule can be. They also skip over the reality that you can't simply use your own money without consequences. Every loan reduces your available death benefit and increases the risk of collapse. Next, let's touch on the hidden tax traps. This is where things get dangerous, especially for people nearing retirement. First, you've got that whole Modified Endowment Contract thing, or MEC. If you overfund the policy incorrectly, it loses its tax-favored status. Now every withdrawal is taxed at ordinary income rates, and the loans aren't tax-free anymore. Second, you've got to think about the policy lapse potential with those loans. There is this phantom tax illusion. Borrowing isn't taxed while the policy is in force. But if the policy lapses, the outstanding loan balance becomes taxable income immediately. All those quote unquote tax-free loans suddenly get recast as taxable distributions. That can trigger tens of thousands in taxes in a single year. Third point on this, there's no step up in basis. Unlike other assets that pass tax-free at death with a step up, cash value doesn't get that benefit. It shouldn't matter because when you're gone, your beneficiaries should be receiving the full tax-free death benefit, but it's worth mentioning because, well, circumstances vary. So let's put some numbers to this. Imagine a policy with $1 million death benefit. Over the years, you've paid, we'll say, $200,000 in premiums out of pocket. Now, let's just say that the cash value has grown to $350,000 somehow. Along the way, you've borrowed $200,000 against it. The loan accrues interest, which pushes the balance higher each year. If the policy lapses, here's what happens. The IRS looks at the $350,000 cash value, subtracts your $200,000 of premiums, and says, you have $150,000 of gain. That $150,000 is now taxable as ordinary income, all in a single year. Perhaps the loan is fully covered by the cash value in the policy lapse, but your death benefit is also gone. And now you get a big fat tax bill. What was sold as tax-free access has just become a tax disaster. And here's the part most people miss. That loan balance doesn't stay flat. If the interest rate is 6% on a $200,000 loan, that's $12,000 of interest in year one. If you don't pay it, it compounds. Over 5 years, your loan could easily balloon by $60,000 or more. The faster the loan grows, the faster it catches up to your cash value, and the greater the risk of a forced lapse. If you're using something like a variable universal life insurance policy, then you also have the risk of your cash value going down, increasing the risk of a policy lapse. It just makes my stomach turn thinking about people actually getting into these situations. We should talk about the sustainability problems. This is the real kicker. To make infinite banking work, you have to keep aggressively funding these policies for 10 to 20 years. That might work for someone 20 or 30 years from retirement, but it doesn't line up with someone who is about to retire. If you stop paying premiums or reduce contributions, the policy can implode, again, triggering taxes and wiping out the benefits you thought you had. For many people getting close to retirement, that long funding horizon just isn't realistic. You're likely better served by strategies that can adapt if your cash flow changes, rather than a rigid policy that punishes you for slowing down. Okay, so let's talk about the infinite illusion. The term infinite makes it sound like you've unlocked a perpetual motion machine of money. But here's the reality. In order to keep pulling out new loans, you either need to pay down the old ones or watch your available cash value continue to shrink. If you don't, the interest snowballs, your policy weakens, and eventually the entire structure risks collapse. Infinite isn't infinite, at least not in this. It's conditional, and the conditions are tough. This should be called conditional banking. conditional life insurance banking. I don't know. It's definitely not infinite banking. Now, all of that being said, there are those out there who this might actually work for. I want to be even-handed, so I'm willing to admit there are niche cases, or is it niche? Niche cases? Well, there are places where this can work. High earners who have 10 to 30 years until retirement with very stable cash flow, who've already maxed out retirement accounts, and who want to use life insurance as part of a legacy strategy, well, they may find some value here. Business owners who want forced savings and disciplined funding might also benefit. But let's be clear, this is a very narrow slice of people. For most late career professionals preparing for retirement, the risks, costs, and complexities far outweigh the potential benefits. Think of Jim and Lisa, a couple in their late 50s. They were pitched infinite banking as a way to create their own retirement bank. On paper, it sounded like they could borrow tax-free and always have access to money. But when they looked closer, they saw that the premiums were steep, the loan interest rates ate into their future benefits, and the long funding horizon, 15 years until there was a meaningful cash value to take a loan against, didn't line up with their retirement timeline. They realized they'd be locking themselves into a contract that made their retirement less flexible, not more. So what potentially works better? Instead of funneling retirement dollars into an expensive life insurance policy, here's what I see often working better. Roth conversions done during your low tax years. Flexible brokerage accounts with full liquidity. A coordinated portfolio that balances growth, income, and risk management. If your goal truly is protection for your family, there are also straightforward insurance solutions that do the job without the baggage. Term life insurance or guaranteed universal life insurance can provide death benefit protection in a much cleaner, more cost-efficient way. So to put that in perspective, a healthy 55-year-old might pay $4,000 per year for a 30-year level term policy with a $1 million death benefit. A comparable whole life policy designed for infinite banking could run $30,000 or more per year in premiums. That is a staggering difference in cost for the same protection. And while the whole life policy promises cash value, most clients need that money accessible for retirement, not locked up in a complex contract with strings attached. One might compare it this way. Infinite banking is like buying a house with hidden foundation cracks. I'm not sure if this analogy is going to work, but I'm going to keep going with it. It might look sturdy at first, but the cost of repairs and the risks down the road will far outweigh the initial appeal. Maybe should have paid for a better or second home inspector. Meanwhile, Roth accounts and brokerage accounts are more like well-built new construction homes on a sturdy bedrock foundation or with mounts that reach well down into the bedrock below. They can take longer to build. They're going to be a little more expensive, honestly. This is where this analogy kind of falls apart. But if you know the rules and you know the costs, you have options if life changes. Now, I might want to edit that out. I'm not really sure if that's going to work, but who knows? It might resonate with somebody. Anyhow, here's the bottom line. If you need income flexibility, Roth conversions and brokerage accounts give it to you. If you need protection, term life or GUL, guaranteed universal life, will give it to you. If you want both, you can combine them, retirement savings and low-cost life insurance, without locking yourself into a contract that only works if you never miss a step. That's real clarity, helping to build real confidence. Now, let's take some action on this. If someone pitches you infinite banking, ask these 3 questions. Hey, how long until my cash value equals my premiums? Hey, what happens if I stop paying my premium? And oh, hey, what are the tax consequences if my insurance policy lapses? If they can't give you a clear, honest answer, walk away, run away. If you found this episode helpful, don't forget to subscribe and share it with a friend who's thinking about retirement and considering infinite banking. That's the best way to support the show. It's kind of like the thumbs up in the world of podcasts, the secret handshake. And remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purposes. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and are not representative of Tidepool Wealth Strategy or Cetera Wealth Services, LLC. The opinions contained in this material are those of Phillip Smith and not a recommendation or solicitation to buy or sell investment products. This information is from sources believed to be reliable, but Cetera Wealth Services, LLC cannot guarantee or represent that it is accurate or complete. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities offered through Cetera Wealth Services, LLC, member FINRA, SIPC. Advisory service offered through Cetera Investment Advisors, LLC, registered investment advisor. Cetera is under separate ownership from any other named entity.